After the financial crisis entered its most acute phase following the demise of Lehman Brothers in October 2008, central banks around the world, led by the U.S. Fed, began a program of quantitative easing. Now, QE, whereby a central bank buys private sector assets with newly printed reserve money, is said to have helped overcome the financial crisis. Now, the question is, at what cost was this overcome? Our next guest, writer and blogger Gonzalo Lira, believes that the cost of ultra-easy monetary policy is quite high and could be the demise of the U.S. dollar. In 2010, he laid out a hyperinflation scenario for the U.S. that was one of the most talked about posts on the blog Zero Hedge. I asked him whether this was a base case or outlier scenario.
I think it's the inevitable end of the dollar, the way the Federal Reserve has been promulgating its policies, specifically two policies, quantitative easing and ZIRP, that is zero interest rate policy. Now, they promised that they're going to continue with zero interest rates up until 2015, late 2015. And at the same time, quantitative easing is continuing. Now, all this talk of tapering doesn't mean that QE has ended. Basically, it's just that they cut back on the amount of bonds that they are buying. But what QE means is that every month the the Federal Reserve prints up, invents, creates out of nothing but thin air, $75 billion worth of money, and uses that money to go out into the markets and prop up Treasury bonds. Now, without this propping up of $75 billion a month, which is approximately $900 billion a year, without this propping up, Treasury bonds would collapse in value and interest rates would skyrocket. Remember, prices of bonds are inversely correlated to their yields. Now, if you have this situation of escalating yields, of interest rates going up, right, the dollar would simply begin to collapse under its own weight, and we would have a serious run on the dollar and on Treasury bonds. So as the Federal Reserve is kicking the can down the road and trying to shore up Treasury bonds and the wider U.S. economy and propping up the equities markets, because let's keep in mind these record prices that we're seeing in the equities markets insofar as the Dow Jones and the NASDAQ and the S&P 500, these are all the products of the Federal Reserve essentially printing money to inflate these bubbles. It's classic pump and dump. This is the same thing that those fly-by-night equities brokers out in New Jersey do with penny stocks, of pumping and dumping. This is what the Federal Reserve is doing by printing up this money and propping up the Dow Jones and all these blue chip companies. But there is no inherent value behind it because the problems of 2008 were never solved. And so the Federal Reserve has been very, very good at kicking the problems down the road. Here we are in 2014. But the problems were never solved, and they have become worse to the degree that the Federal Reserve has been printing money and creating the conditions whereby eventually there will be a run on Treasury bonds. Now that's my vision.
I just want to clarify this. Doesn't half that money go to Treasury bonds and the other half go to mortgage bonds, though?
Yeah, they do. But at this time, I do believe that after this taper, I do believe that the ratio is $40 billion to Treasuries and $35 billion to mortgage-backed securities. Now, the reason that they're going after those is in order to prop up the mortgage bond market, basically because of the banks. This is a way to shore up the banks and prop them up and keep them solvent. Because if the Federal Reserve were not making these purchases, and if they were implementing all the accounting rules necessary, the American banking system would be insolvent at this time, because the problems of 2008 were never solved. They were simply glossed over with a lot of money.
Now, you talk about inflation and hyperinflation being two entirely different beasts altogether. Can you explain what you mean by this?
No, certainly. In layman's terms, in the simplest terms possible, inflation usually occurs when an economy is overheating, when it's simply growing too quickly. Okay? And you have producers who begin buying commodities and other inputs for their factories or businesses, what have you, and including labor, of course, which is one of the inputs of any successful business. And they start buying up, driving up the cost of these inputs because they're growing. And that usually you see, a healthy 5 to 7 to even 10% inflation in emerging markets and very quickly developing economies. Now, hyperinflation, on the other hand, is when there is a loss of confidence in the currency. Okay, so these are two very different things. You can perfectly well have high inflation, even double-digit inflation that is not hyperinflation, but rather is the product of an overheating economy. And that's relatively easy to cool down, which is simply by raising interest rates. But a hyperinflationary problem, which we would see, for instance, classically in Zimbabwe, but also in most of Latin American countries during the 70s, 80s, and 90s that went through it at one point or another, whereby you have a loss of confidence in the currency and a drive by the people who are holding that currency to go into other mediums of exchange and just get rid of that currency whatsoever it may be. So you see the difference?
Okay, no, well explained, and thank you for breaking it down in layman's terms, because there is a clear distinction. But if Americans and foreigners lose faith in the U.S. dollar, why wouldn't they lose faith in other fiat currencies as well?
Well, because they're better managed. It's as simple as that. I mean, at this point in time, all currencies are fiat currencies. Okay, so we're not really talking about. It's Mohammed El-Arian has a very, very good metaphor. He's the head of PIMCO, the largest bond trading company in the world, and he has a very, very good metaphor. He says that many times when you have all these fiat currencies, you pick the cleanest dirty shirt, he calls it. You pick the one that looks the least bad. And if the dollar starts to crater, and we will see that by a very simple thing, we'll see the yield curve on treasuries after some sort of panic, it'll be inverted just like in all panics, whereby longer dated treasury bonds are at lower prices and shorter notes are at higher yields, higher yields. Longer ones at lower yields, nearer ones at higher yields, an inverted yield curve. But you'll see that entire curve start to creep up, okay, as you see a run on treasury bonds, okay. Now, if that were to happen, that's when you'd start to realize that the dollar is losing value. Everybody says, oh, you should look at gold or silver. My vision isn't so much that. You should pay attention to the bond markets, because ultimately, any kind of hyperinflation that would happen to the dollar would be as an effect of a run on treasury bonds, okay. Many people sort of misunderstand my point. I'm not saying that hyperinflation is going to happen out of the blue. Okay, what I'm saying is there is going to be a run on treasury bonds, whereby foreign holders of U.S. treasury bonds, start to lose faith as to whether those bonds will be repaid, because ultimately treasury bonds are a store of value. And when those bondholders start losing faith, and remember, outside the United States, approximately $8 trillion worth of treasury bonds are held at this time. Now, when those holders of those treasury notes and bonds start losing faith and start selling those bonds and going into other currencies, that's when you're going to start to see a loss of value. Because ultimately, what I perceive as hyperinflation of the dollar will be, is a run on the bank, as it were. And in this case, treasury bonds are that bank. The effect of losing purchasing power, the dollar losing purchasing power, will be as an after effect of that run on treasury bonds. You see what I mean? Right.
But are you telling me that pounds and euros are better than U.S. dollars?
Probably.
Probably.
Yes.
Okay.
Yeah, long run, yeah.
That was Gonzalo Lira, American novelist, filmmaker, and economic blogger.